Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Pete Wargent, welcome to this second installment of the State of the Markets. How you going, mate?
Pretty good. I can't even remember. Did we do the last one for March 2024?
I think we did, although I think we just said State of the Markets Volume 1, this one being Volume 2. I can't remember exactly, but for folks that aren't familiar, this was a really, really, really popular episode that we put out a few months ago now, and we talk about basically how all the markets are performing. So property, we look at the economy, we look at the stock market, we look at what you can get on a cash account, like a term deposit or a savings account, and then we kind of just summarize each of the key points and help you cut through the noise which is constantly hitting us, whether it's in property, whether it's in shares, whether it's in whatever part of our financial life. So, yeah, Pete, I don't know where you wanted to start, mate. What are you thinking?
Oh, where should we start? Should we start with interest rates and bond yields and all that stuff? Because I guess we can start at the top and work our way down, I guess.
Let's do it. So in Australia, at the start of the year, I think the last time when we jumped on this, actually, we were talking about how it was possible that people thought interest rates were going to fall, but maybe that wasn't a certainty. And if we fast forward 3 months to now, interest rates in Australia have held steady. So the RBA, who sets the rates, have held steady, Pete, but the expectations are no longer that rates will be cut in 2024. So that's pretty, I guess, hard news to swallow for property investors and homeowners.
Yeah, the theme has generally been higher for longer. We got one monthly inflation print that was pretty high in Australia, and it's interesting because we've got these officially quarterly figures, and everyone says, well, the monthly figures are new. There's not much of a back series. They don't cover the whole inflation basket, so don't pay too much attention to them. But human nature, of course, you release a monthly figure and everyone's glued to the results. So yeah, that just one print alone pushed out interest rate cut expectations way back into 2025. I think though, the date that's shaping up to be the key data release is the end of July, 31 July, which is the official quarterly inflation figures. And I think, look, if we get a core inflation figure of 1% or below, then interest rates will most likely be on hold in Australia for the rest of the year. If we get something a bit of a surprise to the upside, well, the Reserve Bank's going to be under pressure then to maybe tighten interest rates even further. So, there'll be a few nerves on that day because even though it seems like disinflation is the trend in pretty much all of the rest of the world or the developed economies, Australia is a bit of an outlier at the moment, and there's various reasons for that. But if you look at Australia's, say, 3-year bond yield, which is a key funding benchmark for Australian property and banks and so on, on the morning of recording, 4.06%. So fairly sanguine at the 3-year point. But in the immediate term, nobody really knows. So there'll be a few nervous people on 31 July, I guess.
Yeah, fair enough. And I think that's an interesting point you raised there, and probably a good education point for folks that are listening. It's like banks have to get their money from somewhere. And so when Pete and I might talk about bond yields, it might sound like a bit of gobbledygook, but basically what we're saying is, what is the cost of capital? So what is the cost for these big institutions to go and get their funding? And it's not just banks that rely on those metrics. I mean, as analysts, we were trained in uni that the 10-year bond yield was the only benchmark that you use for pricing and valuing shares and businesses. So these are important things for us to understand. And as Pete alluded to, inflation is kind of the key thing that drives expectations around that. And then that's why you see fluctuations. Like, a lot of people think, well, if interest rates get cut, that's a good thing. But the thing is, it may already be priced in. Expectations may already be there. So it's not just necessarily going, A minus B equals C. Sometimes there's a lot more to it. How about if we look across the pond, Pete? We've got in the in the US, it's kind of a different story for folks. So the annual rate of inflation in the US, I'm reading here, fell for the third straight month to 3% in June 2024, the lowest since June 2023. That was down from 3.3% in May and below forecasts of 3.1%. They've obviously had some like gasoline prices and things like that. But in the US, inflation, they seem to have tamed that beast for at least the last little while. What do you think?
It does seem that way. So just going back to your previous point there. So for Australia, the biggest influence on the mortgage rate we pay is the RBA's cash rate target. But also, yes, funding costs also have a role to play. And in fact, I think it was yesterday on the day of recording, National Australia Bank actually cut their fixed rate mortgages by about 60 basis points. Now, most people are just borrowing on variable rates at the moment, but it does sort of show that expectations for interest rates, at least overseas, are now coming down the other side. And that's not just the US. If you look at Canada, New Zealand, United Kingdom, even China cut interest rates this week. So, yeah, I think if you look at what's happening in the US, always important, of course, because it's the biggest and most influential global economy. So they've had a run of softer inflation figures over recent months, excluding housing, actually. Housing's been the one sort of area where inflation's been quite sticky. But I think a lot of analysts and market commentators have almost declared victory over inflation in the US, and they're looking at a first interest rate cut. Well, if you look at market pricing, 100% probability priced in by September, which is only really just a matter of weeks away, and that's before the forthcoming US election, which is chewing up most of the headlines at the moment. And if you look further ahead, if you look at what, for example, like Citi are saying, well, the federal funds rate in the US is expected to fall by around 200 basis points to mid-2025. So I guess if you haven't been following along at home, the US interest rates have been hiked quite strongly since March 2022, 11 times. Interest rate went up to 5.25 to 5.5% since to July 2023. Well, now looks like we're coming down the other side. And the reason that's significant is, I think if you follow the trend for US interest rates, that's going to have quite an influence on the global narrative. And I think, yeah, if you look at UK, people are already looking forward to interest rate cuts, New Zealand, Canada, and here's Australia, and we're still talking about inflation risk. So we're kind of stuck out there on our own a little bit at the moment.
One of the things that can happen if the US and these other markets start to cut interest rates, your overseas holidays might become a little bit cheaper because the Australian dollar might actually strengthen against those counterparts because the Australian, interest rate setting is still higher. During this quarter, we saw that mostly there was some pressure on the Australian dollar, but towards the very end, I'm talking in the past few weeks at the time of recording, Pete, the Australian dollar started to bounce back a little bit from some lows. So it's nudging right up at 67 US cents. As someone who has just come back from overseas, I wasn't buying USDs, I was buying euros. But I can tell you that I had a bet with my father-in-law. I bet him a pizza in Rome that I reckon the Aussie to euro conversion would be better by the time we went over there. He won, it turns out. But I think what we're starting to see is some upwards pressure, at least expectations maybe, that the falls that we'd seen in the previous few years might not be in store. I'm curious if you've had any thought about that. If not, it's all good. But
I think
quite interesting.
Yeah, there was a lot of talk at the beginning of this year about the Aussie dollar coming under pressure, but it's really surprised a lot of traders with its strength. And I think it's what they call the traditionally risk-sensitive currencies have performed pretty strongly against the US dollar over the past few months. And I think that's, that probably partly reflects, as you said, the relatively hawkish monetary policy stance in the Reserve Bank in Australia versus the US, where it does seem like, well, inflation's pretty much been beaten. And now the debate is really turned to when will interest rates be cut and by how much. So, yeah, as you said, it has an influence on things like overseas travel. Also, it's a part of the inflation story as well, of course. So, a lower dollar in Australia tends to be stimulatory exporting country and so on. So yeah, it's been a bit of a surprise, but I think I haven't looked this morning, but we're up around 67 cents or so. A lot of people were forecasting earlier in the year that would be quite a lot lower than that. So a bit of an upside surprise, I suppose.
Yeah, it is indeed. And if you have portfolios in the share market and bonds, these types of things, when people start to think about those as well, if I can switch gears and come back to straight into the pockets of folks that are listening, in recent years, something we talked about last time, Pete, was the household savings ratio. People may remember that during COVID and during stimulus, we had unbelievable numbers in terms of what we were seeing in the household savings ratio, the amount of money that households are saving, up to the tune of, it was north of 20%. And people couldn't spend, people couldn't go on those European or the US holidays or even to the Greek island of Rhodes, Pete. So people couldn't do that at the time. But now we've seen, since this, I guess the increase in interest rates, in domestic interest rates here in Australia, that rate of saving has fallen from over 20% right down to around about 3% or less. And just in the last reading, in the fourth quarter, we saw a bit of an uptick in the savings ratio. I don't know how much you pay attention to this. I quite like to look at it just to see what the ABS is saying about how much households are saving. Any thoughts about this?
Yeah, I do look at it. I think it's important to remember this is almost like a derived figure. So it's almost as though the ABS looks at what's happening in terms of household incomes. It looks at interest payments on properties and then other household payments. And then the balancing figure of what's left is effectively how the household saving ratio is calculated. And as you said, I think it was the June 2020 quarter, saving ratio was like 24%. I mean, we haven't seen anything like that for decades and decades because we were basically stuck at home. Borders were closed, couldn't fly overseas. People didn't want to buy new cars. And yeah, there was a huge amount of uncertainty there for a period. Now, I guess when the economy reopened, we had a bit of a hedonism trade as people, they took the opportunity to get out there and spend. But then I guess, in recent quarters, we've seen mortgage repayments have really shot up. Interest repayments have more than doubled. We've had rents going up. The cost of food has gone up. And you mentioned some of the other issues with energy prices. I think in the March 2024 quarter, the saving ratio, which it does get revised around a little bit, but it's basically about 1%, 0.9. So, very, very low. So, I mean, in the one sense, it shows that people have been spending, but it does show that, households, at least some households, are coming under quite a lot of pressure now with those higher mortgage repayments, which is, of course, exactly what interest rates are expected and planned to do. They bring down household consumption and slow the economy, bring down the rate of inflation. So, quite a few households, certainly leveraged households, are under quite a lot of pressure now.
Yeah, and to be honest, I see that, and I think, we've got to be careful not to cherry pick data points, but anecdotally, just speaking to families, particularly families with accumulators, not so much the retirees, they seem quite a bit more happy with their higher interest rates on their term deposits and so on and so forth. And bond yields, I might add, they're getting a return finally. So they're quite happy. But for the vast majority of folks that are still working or have a family and a mortgage, I do see them reporting to us that they are starting to struggle a bit more. We actually see it in our analytics as well, Pete. We see it in the different types of episodes that people would watch across the Rask network. We see that too. Turning briefly before we get to the fun stuff, which is property, shares, all that good stuff. Retail spending, we could see that retail sales in Australia rose by 0.6% month on month in May 2024, picking up from a 0.1% growth in the prior month. And so it's exceeded forecasts. So basically, this metric, I'm not sure how much you lean into this, but more positive, more resilient in the last little while. We have had a few periods of negativity over the last year or so. But how much does retail sales play into your thinking of what's going on in the economy and any commentary around it?
Yeah, I mean, you're right. The last figures were more positive than expected. They do jump around a little bit. And there have been some challenges around the seasonal adjustments in recent years because we've had things like Black Friday sales and then the release of iPhones and other things that have been pretty unusual. I think essentially what happened was we saw a huge rebound from around the middle of 2021. Retail turnover was about 29 billion a month, and now it's running at about 36. But I suppose there's a few different things going on here. One is that the population has increased dramatically over the past 2 or 3 years. Also, of course, the cost of goods and services is up quite sharply. So I think if you actually look at the volume of retail turnover, it's been pretty lackluster now for over a year. So yeah, I mean, there's a few different moving parts, because if you just look at retail turnover, well, yeah, the prices of eating out or goods and services is up quite significantly, which is the whole inflation problem. But also the number of people in the country has rebounded a lot. So if you looked at the volume measures, not quite so clever. So again, though, that's kind of what monetary policy is expected to do. And if you look at Australia's GDP or sort of growth in the economy, same story really. Growth is positive, but if you actually account for the increase in the number of people, well, we've really been going backwards for a year or so.
It's interesting. So when you're looking at retail sales, if someone puts the figure out there, you would rather see volume as a kind of adjust for those prices?
Yeah, so you only get the volume figures typically once a quarter. So monthly we get the retail sort of nominal figures, which is the dollar amount spent in current prices. Yeah, but then once a quarter we get the sort of the retail volume figures, and that feeds into the national accounts, the quarterly GDP figures and household consumption. Yeah, I mean, it's been weaker over the past 4 or 5 quarters per person, but that's kind of what we'd expect to see, because we've got significantly higher interest rates now than we did 18 months ago.
So turning to the things that people can actually invest in and actually talking about beyond just the headline figures, Pete, we've got things like Aussie, US shares, heck, even European term deposits. We mentioned bonds already. The yields on bonds, just as an FYI for folks that are interested, are all of a sudden really, really compelling. So one of the mistakes that people make with bonds and bond ETFs in particular is they look at the last 3 to 5 years and go, bonds are bad, poorly performing, but that is actually what makes them so interesting right now, is that exact thing. They're not like shares in that way. So really interesting. But aside from that stuff, let's get to the juicy bit, which is property. Let's talk about resi property, like residential property. And if you have any remarks about commercial property, I know you and your team do a bit of work in that, but if I just scream off the headline figures that I've got here, I've got 8% for the Australian property market overall, 8% returns for the year to 30 June 2024, which is wonderful. I mean, probably in line with long-term expectations, you might say, but that's really, really interesting. Like, I think some of the outliers were Perth at 23.6%, Adelaide and Brisbane around 15%, Brisbane closer to 16 actually, Sydney at 6%, Melbourne 1.3%. Hobart was the only one negative, while Darwin and Canberra low or mid 2% range. Let's just go. How do you think about it? Any surprises? Anything there that you thought, wow, that's good, that's bad? I know you talk about this every week with Chris, but curious to hear your thoughts.
I think if you were to zoom out a little bit, let's say zoom out to a 20-year time horizon, and you often find that the returns by capital city are actually much more similar than they are different. I think when you look at individual pockets of time, you think, well, hang on, the Perth market's booming and Melbourne's flat. But if you were to zoom out and look at 20, 30 years, but within that time period, you get market cycles, of course. And particularly in Australia, you do find that sometimes the resource estates move at a different time of the cycle versus the big services-based economies in Sydney and Melbourne. So exactly what we've seen over the past 12 months. So if you look out to third week of July, we do get daily updates now on housing prices, rightly or wrongly. But yeah, I don't know if this is a good or bad thing, but Perth is up 24.5% over the year. So I was just in Perth a month or two ago, and you can see it's absolutely red hot. You can almost just feel the wealth in a city like Perth. Just really noticeable when you travel around the world. I went to look at the Optus Stadium, and it's just this sparkling new precinct, fully paid off by the government already, and it's just an asset for the state. It just really is the resources wealth in WA is just so noticeable when you travel around a lot. Well, we had 10, 12 years of nothing for the housing market in Perth, big overhang of properties around 2011, 2012. Well, now we've got the opposite problem, massive shortage of housing. Listings are really tight, rental vacancies very, very tight, near record lows, and everything is booming. Properties are selling before the first open home a lot of the time. Prices are just rocketing higher. Now we are starting to see building approvals respond to that, which is what you'd expect. So if we're having this conversation in 12 or 24 months' time, it might be different. But in the meantime, it's just a full-on property boom in Perth. And it is a very cyclical market, as we've seen before during the resources boom years. Brisbane and Adelaide, not quite so dramatic, but still listings are very sort of low year on year. And Brisbane prices up 15%, Adelaide nearly 16%. Sydney and Melbourne, Sydney's up about 6%, and Melbourne over the year 0.5%, and actually negative over the past quarter. So, a few headwinds for Melbourne, I suppose. There's different stuff going on. Government debt's been quite high. There's been land tax changes, quite a few policies that have pushed landlords away. So there's a few things that have kind of relatively depressed prices in Melbourne compared to elsewhere. But as you said, you net all that off, and then sort of across the capital cities, about 8% capital growth over the year, plus the rental return, which might be 3 or 4.
Which is pretty good. Pretty good. Can I ask, I think it was the beginning of this year, you and I spoke on the Australian Property Podcast, because you and your team are buying properties for clients. You've got a buyer's agency in Brisbane, and you do a lot of work in Queensland, as well as around the country, but particularly up there. We've seen the Brisbane market be really good performer over the last few years. But at the time, I remember you saying that stock was really, really low. Are you still finding that?
It is. I think it's not quite as hectic as it was. I think one of the things we've seen with higher interest rates is that more buyers have been pushed down into some of the lower price points. And we're seeing a lot of demand for units, townhouses, duplexes, that kind of property, just because of the affordability constraint now. I think at some of the higher price points, it's a little bit patchier, but even so, prices are certainly up year on year. And as you said, actually, really since the COVID period, Brisbane and Perth and Adelaide have been very, very strong performers. I think slightly different. The industrial property market is also extremely strong in southeast Queensland. But office space is the one sort of area of real weakness. I think if you look nationally, office vacancy rates are probably around 15%, which is the highest since the early 1990s recession. So that suggests that rents are still falling, valuations are still declining quite significantly. And that's partly interest rates, but it's also that acceleration in the trend towards working from home. It was happening anyway, but COVID dramatically accelerated that. So particularly if you look at Sydney and Melbourne, office vacancy rates are just heading up and up at the moment.
But in terms of valuation, Pete, I might push back on that for one moment. Are valuations actually falling, or is the kind of the Ponzi of valuer meets landlord meets doesn't have to write down the value of something?
It depends. It depends. There are some instances where CBD offices have traded at a lower price than previously, where they were valued. But it's a patchy market. With the residential market, we get daily updates now, and it's very easy to create an index. But of course, in the commercial space, it's not really like that because every property is different. So I think it would make sense to me that with interest rates going from 0 to a cash rate target of 4.35, I mean, generally the price that people are prepared to pay for office space, and indeed commercial generally, would be expected to be lower. But I think if you looked at some of the markets around the world, like San Francisco and Denver and Toronto, and there's no end of examples where we've seen some absolutely cataclysmic declines in some of the office valuations as traded, but it just doesn't seem to have been as dramatic in Australia. In fact, in Brisbane, office vacancy rates are on the way back down. I think just the sheer weight of population growth, and Perth is not faring too badly either. But yeah, Sydney and Melbourne, there's quite a lot of particularly B-grade office space that's just struggling. I think the A-grade stock's doing okay.
Well, it's like what you and Chris talk about on the property podcast, is that quality properties don't fall as much as, the next level down of quality. And so, yes, they may be more expensive, but they tend to compound very well and protect your wealth. So if just one more thing on this before we quickly move over to shares, in terms of like commercial property, warehouses, offices, like if you just took that whole spectrum of everything outside of resi, you could take this through the lens of just Queensland, where you do a lot of your work, or down the East Coast or whatever. Do you think where would you be, what asset class would you be looking in if you were looking at those things? Would you be looking at like industrial properties? Would you be looking at warehouses? Like, what are the types of things that you're seeing people want?
Exactly that. I think with commercial property, if you're an individual investor, there's a different risk to be managed, and that is vacancies. Because in a commercial property, the vacancy rate, the vacancy period can be quite a lot longer, especially if you go to a niche type of property. So, but things like warehouse space, industrial, sometimes you might have a shed with an office attached, something like that, which is fairly easy to find new tenants. Well, yeah, that's really popular. I think as well, assets like medical centres in particular. We've got a growing population, ageing population. So, yeah, that type of property is quite popular. There's a lot more sort of nervousness around office space at the moment, and just a bit more caution. I think until people know what direction things are going into next, understandably, people are pretty nervous about that.
Yeah, absolutely. I was chatting to a family member of mine who lives up in Cairns, and he was saying, this was going back to the start of the year, he was saying that he traditionally he'd just have like one investment property fully paid off, and that was basically his income. But when he moved up to Cairns from Melbourne, he looked around in the warehouse, what he could get for initial capital outlay or the yield. He was like, the vacancies there's virtually none in all of Cairns. So he's like, I bought one, added a mezzanine floor, and it's been unbelievable. And I just think about that a lot. And so folks that aren't aware, you can look outside of the traditional residential asset classes for different types of property exposure. You can do that through a professional. I know Pete and Amy talked about it and the stuff that they've done in the space, but also, you can look in other ways. Turning quickly to term deposits, you can get a term deposit. This is no affiliation with ING Bank, but it does offer 5.1% on an annual term deposit. So a year-long term deposit, which if you go back 5 years, people would have been falling over themselves to get into the bank if only ING had branches. But most of the banks are offering high fours, around 5. And if National Australia Bank's lead is anything to go by, maybe, in a couple of years we're saying, I wish I had 5% again. So we don't know for sure, but maybe that's what we're saying. So I'm seeing a lot of our clients and our investors, what we call rolling TDs, is they'll have 3, 4, 5 different term deposits of various maturities, and one rolls off and then they renew it, and then that way they're kind of extending what we call the yield curve. They're kind of extending their higher yields, knowing that their money isn't 100% liquid. But they're able to capture some of that. And if interest rates do fall, they've kind of locked in a couple of them for a little bit longer yet. Now, the two areas that I'm really keen to talk about, Pete, are the share markets of Australia and the US. We could also talk about global markets because it's been the same kind of story all over. But off air, you and I just spoke about the S&P 500 return this year, like 2024, is 16%, positive 16%. When we previously did our update, we were saying it was 9.5%. Year over year, the S&P 500 in the United States is up something like 22%. These are, now, sure, long run averages, you said property before, if you include the income, maybe it's around 12% for the year, which is maybe slightly above average. But for the S&P 500, the US market, I can tell you for certain, 22% year over year is above average. But it's been a top performer for a long time. Has this, just as a general gist, Pete, has this surprised you?
What, the S&P 500? Yeah, sure. And I think, you can always bring up the graphs that shows our valuation since 2009, the valuation versus almost any valuation metric you care to mention is stretched considerably. But, people were talking about a market peak around, 2018, 2019, and we did get a downturn, an absolute rocketing back when the Fed stimulated the economy, then a bit of a downturn for tech stocks, and now back to the races again as markets are looking forward to interest rate cuts. So, yeah, I think, generally try to think about stock market returns over longer periods than a year, because the more you try to fine-tune the timing, it's really difficult. And particularly with individual stocks, you really need to do your homework. But, it has been surprising. And, we were saying just before we came on, weren't we? There'll be a pullback at some points and everyone will say, I told you so. But look at the returns over the past 15 years. Phenomenal, really, for the S&P 500.
Yeah, and even the Aussie market, if we turn our gaze to that, is 6.4%. Keep in mind, ladies and gentlemen, we're only talking about 6 months or thereabouts. So we're not talking about any great stretch of time. That's in total returns. And I think, Pete, you touched on a good point there. The market could go up 10%. And in the meantime, someone's waiting and saying it's going to fall. It's near a peak. I read some stupid blog about how this valuation is so high and blah, 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 blah. And then it falls 3% and they go, told you. Meanwhile, they've lost the 7% that they could have had by just being invested. And
you can apply that to any asset class. You can apply that to Bitcoin, property markets. There's people waiting to say I told you so about prices in Sydney since I first started tracking it in 1997. And you look at the returns, I wouldn't even like to think they've probably been 5x since then. It's like you get a 3% downturn and everyone says, told you.
But the thing is, those are very seductive, those news headlines and those analyses that people do. And there's a saying that I love is that all markets climb the wall of worry. And basically, you are paid the return of long-term investments for taking on that worry, for taking on that uncertainty. That is why you make money. And I think that every time I hear that, I zoom out, as you said, you just zoom out back and back and back. And it's pretty obvious over 30, 40, 50, 100 years. Just look at the annual returns, and like the average annual returns of property, shares, US shares, all these things, and how they're relative to cash and the conservative assets. I think it was Peter Lynch that once wrote that, a famous investor from the US who once wrote that more money has been lost staying on the sidelines than in market crashes. And I kind of believe that. I think a lot of people miss the opportunity rather than try and time their way and just never get involved. And I think that's the great shame.
I think for people who aren't using leverage, that is almost undoubtedly true. I mean, what would the S&P 500 returns be over 60 years? About 10% per annum. And if you're sitting waiting for that golden opportunity, they do come round, but to not be invested for long periods of time, you're leaving a lot on the table there. So I think it's different when people absolutely wreck themselves by trading leverage products and so on. But if you're just talking about an investor with cash and stocks, well, I'm sure that would be true.
Yeah. Final piece on this is, of course, past performance is not necessarily indicative of future performance. So do zoom out, look at 3, 5, and 10 years rather than the short-term returns. And also note that most of the things that you see in the news, like the ASX 200, if they say that, or the S&P 500, if they say that, typically what the news readers are talking about is not the dividend included version. So there are like indices, what we call indices, that you can track, and you can see what the dividend version of it is. And people have been saying for the last little while, the Australian share market's at an all-time high. Well, if you include dividends, it was at an all-time high a long time ago. And same with the US markets, and to be honest, other markets like the UK and now Japan. Pete, we've covered a lot of ground. We've got US interest rates, maybe benefiting from lower inflation towards the back end of the year. Property prices in Australia doing very well over a short period of time, being 12 months. We've got Retail volume down, but retail sales consistent. We've got the Australian dollar kind of inflecting back up. Household savings maybe showing some resilience. Bond yields looking good for retirees. After all is said and done, US stock market up, cash accounts yielding good returns. Is there something that you would be watching? If we could leave anyone listening to this with something, what would it be? Other than maybe that you said the 31st of the month or something like that we'll see some data come out?
I think there'll be three risks to mention. So one is, the potential resurgence of inflation. So for Australia in particular, because we haven't yet got inflation back down to the 2 to 3% target. So that is one risk to watch. I think another one is a potential spike in unemployment. At the moment, the labour market has been phenomenally strong in Australia. Unemployment rate is still 4.1%, which is very, very low. But if you look at the forward-looking indicators, job ads falling, number of people applying for every job, there's been a massive spike there. The economy's generally been slower. So there is a potential risk that the unemployment rate could go from 4 to 4.5 to 5%. That changes some of the dynamics around things like property investments and just the economy more generally. And I think, we touched on the third one, and that's office valuations. At the moment, things seem to be holding up pretty well. In Australia, we've got a somewhat different dynamic. Bank exposures are pretty low. Lending is quite conservative in Australia, but it's just something to keep an eye on there because that tug of war between employers and employees is still ongoing. Maybe as the unemployment rate rises, employers will get more people back into the office. But it does seem that although employers are often requiring people back in the office 3 to 4 days a week, it's not gone back to how things were in 2019. And I think attendancy rates are probably about 3/4 of what they were. So, you just keep an eye on what's happening in the commercial office space. I think, what haven't we talked about? I suppose the only thing, just scanning through my sort of bullet point notes, just bond funds and bonds. I think we kind of touched on that, didn't we? Generally, as you said, past performance is no guarantee of future results, but that's particularly true when you're thinking about investing in a bond ETF or a bond fund, because what's gone before doesn't necessarily reflect what's going to come. So we had a really tricky period there for a lot of retirees and older investors where term deposits and bond yields were practically zero. But that's not the case anymore. As you said, we've got 10-year bond yields are above 4%. You can get term deposits at higher rates again. So, I think sometimes if you're worried about risk and so on, that's almost like the ballast or the safety part of your portfolio. And it's a nicer position now for people in that situation than was the case when interest rates were stuck at the zero lower bound.
I think that's a great way to end it, because you talk about like the key risks there to these outlooks. And then you mentioned one of the upshots, which is that your backstop as an investor right now is cash and term deposits. I saw some interesting data the other day that you could buy CBA shares, which are punching new heights, and get a dividend that's less than a term deposit, which is not normal for a lot of people that have listened to this. Normally, you take no risk, which is the term deposit. Or a bond fund, for that matter, if you understand how they work, in exchange for very little risk compared to, say, like an individual stock. So I think that's really interesting for a lot of people now. And if we weigh up the risks of doing all those exotic things with your money that you could be doing, the vanilla flavor of investing is kind of coming back. So that's really exciting for folks. And Pete, I know you cover this each and every week, these types of things, but more so property with Chris on the Australian Property Podcast. So if you haven't already, you may be listening to this on the Australian Property Podcast, but if you're listening to this on another channel, come over and join us. And you can catch up with Pete. He's on X or Twitter. You can also get in touch with Pete. I did mention this buyer's agency. There, I'll put a link in the show notes to that. So get in contact with Pete, see how he can help you. And mate, you've been a great help to me today. I've got to go and present some data later today. So I'm going to take some of these ideas and run with it. So I appreciate it, and I really appreciate your time.
Yeah, absolute pleasure. Popping away for a week to Greece, but I'll be back on deck the following week. And all in good time to see what happens with inflation 31 July. So looking forward to that.
I'm sure you'll be checking it while you're sunning yourself on some beach somewhere, mate. So, I love it. Have a great trip, and thanks once again.
Cheers. Thanks, mate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.